Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we're meeting with Matthew Piepenburg of Von Greer. How you doing today?
I'm doing great, Darrell. I've seen a lot of you in the last 5 days. Now we're in different hotel rooms at the same event, but it's good to connect again.
Yes. Rural Symposium, obviously. It's been a good time. I think just interacting with many guests like yourself and many of the speakers, like I'm learning quite a bit. I think the audience has been, learning quite a bit. They have a lot of questions and such. And so what's kind of been your experience with many of the average folks that are coming up to you to have conversations? What are some of the concerns? What are some of the questions that you're getting?
It's amazing. And first, I got to give kudos to Rick Rule for just, again, outdoing everyone else and himself in vetting a really good group of vendors here and speakers on the equity side and then experts in precious metals. He's really careful. He's turned down a lot of checks so he can really screen the folks that are presenting here and give the visitors a highly vetted wedding list, guest list, so they can enjoy the event. And I think to your question, a lot of the folks coming here are fairly familiar already with precious metals, whether it's just as a wealth preservation asset, just physical gold and silver that we at Von Greer's are clearly all about. We're not into the equity side or the embedded leverage and opportunity in the mining space, but there's obvious correlation between precious metals, the spot price, and precious metals equities, and we're all in the same kind of universe together. And I think the guests who come here, who've come from all over the world, I've talked to folks from Hungary, from Serbia, from the UK, from Australia, obviously from all over the United States, from France and Spain. So there's a massive crowd of interested people who've come a long way to listen and to learn more, but they come fairly prepared about the nuances of the precious metals market, fairly prepared in consensus on the real trade here, which is the devaluation of paper currencies, whether that's in Europe or South America or even in the United States. So it's an interesting audience. It's a more, I think, vetted audience in the sense that they're fairly clear. But of course, Darrell, to your question, they've seen cycles. They understand how cycles work, including in gold. But of course, they're concerned about the headlines, the daily emotional drip we get, whether it's from the Strait of Hormuz or whether it's from the spot price in the metals, or whether it's the valuation changes in the mining side. I think they're used to it. They're fairly patient and calm. But of course, the big questions: what really explains the post-2025 high and the fall this year in the gold price? What can we expect from the risk asset markets and the diversion there? What really caused these falls? What will cause gold to reprice and the metals to gather their momentum again in this cycle and in this particular time in history? They're questions that experts and beginners alone share, all of them share. And there's a lot of good answers here, more than just apologies, more than just defenses, but reconfirmation of the bigger themes that give this trade so much conviction and patience through the headlines we're passing through now. But it's a really exciting audience. It's a really exciting group. And again, I'm not working for Rick Rule, but I want to congratulate him on really putting together a fantastic event.
Yeah, of course. Rick's definitely a good friend of us at VRIC, and we've learned a lot from him. So yeah, definitely a shout out to him. So you're not getting so caught up in these headlines. And one thing I've noticed about you in our time interviewing and meeting in person is that you hold strong to your convictions, and you're not swayed by a lot of the, sensational headlines or, Strait of Hormuz, whatever the case may be. So so some of this is maybe related to your experience, in Wall Street before, but how do you hold such conviction, and how do you remain, level-headed whenever there's volatility or whenever there's these headlines that could scare some investors away from the market, from gold and silver?
Yeah, a lot of people would say I just have to sell my book and stick to the same line and be right twice a year like a broken clock is twice a day. But I think it's much more than that. I do think your point about having a Wall Street background, not just a precious metals background, and watching cycles in any risk asset or any commodity, as someone who spent most of his career in the markets, that gives me an advantage and maybe a bias, of course. I don't blame those who make their living outside of the markets, because why or how could they keep track of the things I have to look at every day? You know, you can be a sophisticated investor, but you may have a small business. You may have commitments in many other areas that don't involve looking at bond yields or looking at precious metal prices or looking at the forces. So I have that advantage. But even before I look at gold in particular and what keeps me calm, and if anything, it actually adds to my conviction, it's very clear. Having looked at any asset class or any sector, when you're in a secular bull market, there are always shakeouts. And Rick knew this back in Vancouver in January, and he was talking very openly about it. This is no surprise. I think, you know, in context, when you look at bull markets in any asset class, but even in gold, we saw the most famous example, the decade of the stagflation of the 70s. We saw gold hit all-time highs from 35 to 850. It was a massive move, but during that decade, there were at least 5 moments where gold corrected by more than 20%. And halfway through that incredible bull run, there was a massive shakeout between 1974 and 76, where gold was cut in half before it went up 8 times. So I'm used to seeing bull market shakeouts from dot-com stocks and bonds to even precious metals. Now, of course, the 1970s is very different than 2026, or the bull market, and certainly the price action we've seen since 24 and 25. Interestingly, and this is just based on the math of debt and the direction of the bond market and the direction of the spot price and the direction of central bank stacking, 2026, in this period we're in, which is really only chapter 2 of the bull market, is much more compelling case for gold than the 70s ever was. It's just at every level, the fundamentals are far better for gold now at 4,000 or 5,500 than it was when gold was at 35 or 100 or 200 or 600. And we can go into some of the reasons why. But again, the volatility or the retracements in the price are very near term. They're very deliberate. They're very shakeout. You can look at them technically or fundamentally to explain them, and we can get into that. But I have the conviction because, and I'll say this as just a broad answer, the direction of gold has nothing to do with the inherent properties of gold or what gold stands for as a piece of metal on the periodic table. The direction of gold is so obvious to me because the direction of debt, and therefore the debasement of the currencies needed to monetize that debt, is now so inevitable and so openly obvious. It's not in futuro, it's happening as we're speaking, and it's been happening for years. So the conviction we have in gold as real money, as opposed to paper currency, which is confetti, couldn't be stronger because the evidence is literally all around us that faith in even the most reserved, the most respected world reserve currency and the most respected IOU from a government bond issuer, the US 10-year, is openly and objectively, that trust is declining, and the move towards real money, sound money, a real store of value is open, objective, and obviously moving towards gold. And we can get into the reasons why, but that's the real answer. The direction for gold, regardless of its price action, which is a distraction, really a distraction, is really, I'm agnostic, because the real story is the debasement, the trade they call it, but it's just the devaluation of money to monetize debt, which is as old as history itself. And gold's emergence now as a real trusted collateral isn't even a debate. It is obvious. And for those who understand those forces, you're very calm during this period, very calm.
Yeah, for sure. So many charts out there showing that M2 money supply is on the incline. I know that, I mean, if you look at an overall chart, I mean, you just see like
Sure.
it's constantly, on the incline. You may have some dips here and there, but the trend is up. Do you see M2 money supplies accelerating, and this driving, gold's value to increase? I mean, because of the debasement of the currency.
Yeah, I mean, this is wonky where you talk about M0, M1, M2. And again, for most of your audience, I respect that they don't want to get into the distinctions of that, but, we're basically creating more liquidity, more money to monetize debt. And to answer your question, the short answer is absolutely yes. The trajectory of M2 money supply over the last few years has been astronomical. There has been a lot of headlines, and we can get into this too, about Warsh being hawkish, money supply, balance sheet tightening, a new Fed sheriff in town. He's going to be far more austere. A couple of things I'll remind, Trump, they thought Warsh was going to be pro-Trump and low rates, and now they're talking about rate hikes at the end of the year. It's irrelevant. It's also important to recognize that Trump not only nominated Warsh, he also nominated Powell, who was probably the most dovish central banker we've ever had. Of course, he had the COVID crisis. But what's interesting, the M0 base money supply, which is really what the Fed is all about, which leads to an expansion of credit, which leads to an expansion of M2 money supply. Already in his first few weeks, Warsh has been more dovish than Powell was at the end of 25 after he pivoted from higher for longer to dovish. There's been a $24 to $30 billion increase in the M0 money supply. The reserve is held at the Fed. Again, a wonky number. All I'm trying to simplify is saying that if you look behind the curtains already, despite the Warsh headlines and the Warsh hawkish talk, he's more dovish than Powell was at the end of his term. And this is just quantifiable based on M0. But, Warsh is also, projecting himself as a regime changer, as a more, independent, less forward guidance, more circumspect Federal Reserve chief, which he certainly would be. But he also is providing backdoor liquidity to the banks, which again is the Fed's only job, is to provide liquidity to the banks, because the Fed is composed of 12 other banks and the Fed chairman and the 12 members of the FOMC. The shareholders to the Federal Reserve are private corporations. Those corporations are owned by the too big to fail banks. The Fed is a banker's bank, and its job is not mandated employment or mandated inflation. It is liquidity for the banks. No one knows this. It's boring. We talked about this together elsewhere. Recently, Warsh is fast-tracking a way to circumvent the Basel III compliance regulations, and that's fancy talk for he just is going to allow about 90 billion of cash reserves, which Basel III required the banks to hold. He's going to get rid of that cash reserve requirement. When the too big to fail banks no longer comply with Basel III, they'll lever that 90 billion by 10 to 15x to over $1 trillion, and that's just backdoor liquidity so that banks can make more loans. And when banks make more loans, they expand credit. When they expand credit, they print credit into the system. They expand the money supply. Really boring, really wonky. You can look at the syllogism or the domino effect later. All I'm saying is at the end of the day, Warsh is increasing M0. He's increasing liquidity to the banks. He's as dovish as a dove can be. He can talk like a hawk, but he walks and squawks he can talk like a hawk, but he walks and squawks like a dove. And it's all meant to be misunderstood. It's all meant to be too complex for CNBC or CNN or, whatever financial media du jour gives you your Main Street soup. It's meant to be overlooked. But they have been giving liquidity to the banks through the back door, through the Treasury general account, through supplementary leverage ratios, through the yield curve by issuing from the short end, by bailing out the banks in financial crises, whether that was '08 or 2023. There's always liquidity coming into the banks, and there's still just as much, if not more now. And Warsh is a dove, and the liquidity is there. It's just off the Fed's balance sheet. It's highly dovish, highly liquid, highly inflationary, and highly currency debasing over the long term. That's just what I'll have to say, and I'll close with that, but he's no hawk.
Yeah. So, I mean, you could pretend like a hawk until, the politicians get involved and the constituents, which is this like more political class, when they get involved, and you could see some pressure being applied and such. And so,
sure.
Curious. So we talked about M2, thinking about gold and the central bank buying, what do you project there? What are you seeing there? I know that there's been multiple kind of graphics and such coming out about China and how much they've been buying. What are you seeing on that front with central banks?
Yeah, listen, it's extraordinary. And again, everything is a magic trick. There's the price action in the gold price or the silver price that gets all the headlines. What's really happening is not what you see with the magic trick with the open hand, it's the hidden hand. It really tells you the direction of the gold price in central banks. And, the central banks in general, China certainly in particular, have been on a massive run of central bank gold stacking. It really began in 2022 when we weaponized the world reserve currency and the 10-year Treasury and the Ukraine war. And the Putin sanctions, again, whatever you think of that's irrelevant. That changed the momentum of trust in the U.S. 10-year and the U.S. dollar. Since that time in 2022, central bank gold stacking is quantifiably increased by 5x. That's a massive move. In the last 11 fiscal quarters, there was 10 quarters of over 200 tons of gold stacking by central banks. By May of this year, China's already acquired about 160 tons, and they've had 19 consecutive months of gold stacking. Now, you have to step back, get away from the statistics and the tonnage, which even the World Gold Council's reporting of is hardly accurate, through really no fault of their own. A lot of this is off the charts of the CME or anyone else. You can't track this. Many legitimate voices in the space think that the number of gold reported stacking is off by 10x. In other words, there's probably much more than even we reported. But even when we go on what's reported, you have to get back from just the gross tonnage flowing and the consistent quarters and the consistent months of central bank stacking from places as diverse as Brazil and Kazakhstan, Poland to China, and ask why. And that's the real issue. If they're stacking gold and keeping this price resilient, even though there's going to be swings, you have to ask why. And that's the real question. And the obvious answer is these central banks, like sovereign wealth funds, like sophisticated gold investors, have openly and objectively, and like the Bank of International Settlements, have openly and objectively replaced the US 10-year as the global collateral because it's so indebted and untrusted with physical gold. And why? Because at 40 trillion in debt, the US IOU is not trusted as much. It has a higher risk premium. And because it's been weaponized. So in the last 5 years, we're seeing a mathematical increase in the direction of gold going east and going to central banks. They're not collecting this for dental work. They're not collecting this gold to make little shiny monkeys or little trinkets made in China. And they're certainly not doing it for jewelry. They're doing it because the world now is seeing this. I mean, central banks have more physical gold than US Treasuries. I don't make that up. That's something we can quantify. We've seen the central bank stacking. We've seen the pace of gold buying this year is the highest in history. These are just objective facts. Mm-hmm. And so we've also seen a massive exodus or outflow of gold and silver from the New York and London exchanges, which are wonky and boring. But the gold on those exchanges was there to price fix gold and silver because of the available leverage on the physical gold and silver. But that physical gold and silver is running away and it's being collected by sovereign wealth funds and central banks and commercial banks because, like everyone else, they know that gold is the new collateral. I think that is the sea change that no one wants to admit out loud politically, of course. That is the sea change that's way past the gold price debate, way past the Bitcoin debate, way past the DXY debate or the dollar debate. It is the skunk in the woodpile that's being deliberately ignored, and that is just this simple. It's not about just gold as an asset class. It is gold as the new trusted monetary system anchor. And that is not a sensational thing to say. It is right in front of us right now. And that direction of that hockey puck is extraordinary. China is creating an exchange now between Hong Kong and Shanghai, which is going to use a lot less paper leverage and use physical gold and silver to get more trust and to get better price discovery through Hong Kong and Shanghai than we got in London and New York. That's boring, but it's a seismic shift that people need to understand. That doesn't mean that when that takes effect at the end of July on the 24th, that gold doubles in price. What it indicates is that the flow of money is going from west to east, the understanding of gold is going from west to east, and the pricing of gold is going from a completely manipulated, legalized fraud in New York and London to a more fair price physical gold and silver market in Hong Kong and Shanghai, because Shanghai is playing the patient long game. They've watched us shoot ourselves and our currency in the foot since 2014. They've been stacking since 2011. And even the former head of the Shanghai Exchange came in front of a bunch of Western central bankers back in 2014, and he said, very soon, China will set the gold price, not the West. And of course, in those days, which wasn't that long ago, that was considered a joke. Now it's deadly serious. Now it's deadly serious.
They probably laughed at him.
They probably did, because there was that extraordinary arrogance, the exorbitant privilege, the hubris of the West in general and the U.S. in particular. And, you know, hubris always comes before the fall. And we're seeing, again, not the end of the dollar, not the end of the U.S. 10-year. We're seeing a repricing. And it's a repricing based on the sins of their debt and the arrogance of their maven politicians and the dishonesty of their reporting. And now you can't hide whatever you say with words at the Fed or at the White House or at the Senate or at the COMEX, you can say lots of words that trick most people most of the time, but won't trick everyone all of the time. And those in the know and those in the space are clearly preparing for a change in the monetary system and a change in a system that's far more involved with gold as a collateral asset, not as a debate, than the dying, distrusted, unloved U.S. 10-year and the ever-debased U.S. dollar. That is just a fact, not fable, and that is not a gold bug argument. Those of us in the bond market, the precious metals market, the commodities market, in the rates market, we all see this. We all see this. So it's not a gold bug apology or a gold bug sensationalism. It's a convergence of all these forces. And I wish more people on the street could understand this, because traditional retail gold investors are often the last to get the memo. And that's just nothing new.
Yeah, for sure. So what'd you make of this? There was a lot of speculation on July 4th if, President Trump was going to back Treasuries with gold or
right.
something of that nature. And I didn't give a whole lot of weight to it, but I did watch the speech to see if that was going to happen, because they were saying there was some excitement about it, and then many people were disappointed afterwards. And so, obviously, it's still possible; anything could happen. I mean, he could sign something today, and whatever. But
yep.
What'd you make of all that? Is all of that noise? It seemed like it would be a significant shift, but the likelihood of it happening, I'm not sure, not entirely sure.
Yeah, this is the classic, Judy Shelton, a former Fed nominee, really putting her neck out there for the last couple of years, ever since Trump was elected and even nominated. There would be, by our 250th anniversary, an announcement of a gold-backed, long-dated U.S. Treasury. And many thought that would be on the 4th of July. It may or may not ever happen, or it may happen 20 minutes from now or 20 weeks from now. You and I will never know. What I make of that, and what I've said for the last few weeks, as this has been coming towards fruition on the 4th of July, as I said, it's almost, it certainly is relevant whether it actually happens. I think in many ways it will, inevitably. But regardless of that, the very fact that a former Fed nominee has been talking about this is in and of itself a phenomenon that you can't ignore. To see someone basically say we need a gold-backed U.S. IOU and have that taken seriously by the markets and have it debated, and have Besant talk about, monetizing the asset side of the balance sheet for the betterment of American security and people, this is all about gold. And what this is saying, regardless of when it becomes official or more debated or legislated, what it says is that even a Fed nominee and a Treasury secretary are saying out loud that for our IOU, for our bonds to really be taken seriously, they can no longer be backed just by the full faith and credit of the U.S. Treasury Department or the U.S. government or Uncle Sam. We need to give it more credibility by linking it to gold. And that would have never been discussed 10 years ago or 5 years ago in Wall Street or in D.C., because that is the blasphemy in Wall Street and D.C. Gold is the secret they don't want you to talk about, because it's the antidote to the U.S. dollar. Now the U.S. dollar is so openly distrusted that they have to say the quiet part out loud. Even Morgan Stanley has to say the quiet part out loud after years of poo-pooing gold. Last year, they recommended a 20% allocation, and even the too big to fail banks are projecting gold at prices this year higher than I would. So Wall Street and DC have no choice now but to use that four-letter word in normal conversation, which would have never been allowed before. And the only reason it's even creeping up for consideration and possible legislation is because they're saying, and they're admitting without having to say it directly, gold is trusted more than we are. And by the way, that's even true among the BRICS nations. They're not all kumbaya trusting each other, from India to Russia to Brazil, but they do trust gold, and they do have a common distrust of the US dollar. They're not making a gold-backed yuan or a gold-backed BRICS currency. They're making a gold-backed trading system collateralized by gold as opposed to the US 10-year. And that's been in motion for years, and it's happening at a faster pace. All of these countries, including the U.S., are basically saying we trust gold more than the paper promises of Uncle Sam. That should make people sit back in their chair and ask why. And the answer is $40 trillion in U.S. public debt and 360 trillion in global debt and GDP that's 1/3 of that. There is no way to pay for and monetize our debt levels without debasing our paper money, whether that's a pound, a euro, a peso, or a dollar, Canadian, Australian, American. That is the future. And stablecoin will not absorb all those U.S. treasuries. We need to debase the currency, run negative real rates. That is, where inflation is higher than the yield, and then just lie about the inflation and call it positive real rates when it's really negative. And that trick is as old as history from ancient Rome to today, Darrell.
Yeah, yeah. So when you're looking at inflation, what are your typical metrics? Are you using like anecdotes as far as like how much, how many groceries, you could buy then versus now? Are you using shadow stats? Are you using M2 money supply? What kind of or is it a combination of multiple things? So when you're thinking about inflation, like what do you typically use when you're thinking about that?
Well, like me in the street, we do look at what John Williams at Shadow Stats has done, because he's proven mathematically that the scale we use to measure inflation in the Volcker era is completely different than the one we use now. That's just empirical. So if you use the same scale that Volcker would have used when we were running 18%, 19%, double-digit inflation and rates, if we use that same scale, we would be at 11, 12% inflation. We just changed the scale. It's kind of like a fat camp where you literally see your belly getting bigger every day you're at camp, and all you do is eat pizza, milkshakes, and chocolate bars. But every time you jump on the scale says we take out calories from pizza, milkshake, and chocolate bars. So even though you see yourself getting fatter, the scale tells you you're getting thinner. A lot of ways, the CPI scale from the Bureau of Labor Statistics, the BLS, which I just take out the L, it's the Bureau of Statistics, or the BS Bureau. What they've done is they've just created a fat camp scale that takes out all the calorie count. And we feel the inflation, whether we're paying for tuition, whether we're paying for a toll on Route 95, or we're coming across the GW Bridge, if we're paying for healthcare, if we're going down the aisle of any grocery store, even beyond Whole Foods, where I just paid $8 for some orange juice at Whole Foods the other day. I mean, we feel the inflation. And yet we don't need a report to tell us that. But to answer your other question, beyond just Shadow Stats or John Williams, who I think is a hero, an unspoken hero for just calling a duck, like Michael Green or Luke Groman, I look at the compounding annual growth rate of U.S. debt, which is averaging around 8 to 9%. That to me is the real compounding annual growth rate of inflation. They're roughly correlated. Depending on which series of years you look at, you could be generous and say we're at 8%. I think we're closer to 11 to 12%. But really, it's like the audit of physical gold. The measure of CPI is completely fictional. And again, lots of economists have shown that this is always the case. They always lie about the inflation. They have to. That's what I would do if I were a maven to the system and a careerist in DC. I would lie about it. Jean-Claude Juncker, the head of the President of the European Commission, said years ago, when the data is bad, we lie. But the short answer is the compounding annual growth rate of U.S. debt is very correlated to the compounding annual growth rate of U.S. inflation. And even Warsh himself, who's targeting 2% inflation, which, by the way, we've never hit. For years, we couldn't reach it. And for years, we can't get back down to it. We hit target 2% inflation sometime in 2020 for about 50 seconds. I mean, we failed completely. But while Warsh is in Portugal talking to European central bankers about, an aggressive regime change and price stability at 2%, even his own Federal Reserve's projections for inflation are at 3.6. And right now we're at 4.2 official inflation. So it's just a lot of talk. It's a lot of misinformation. This is not sensational. And they're not even close to their own targets. And so again, it's like if you tell a lie long enough, you'll get the people to believe it. And I said, when I was an attorney for years, if I could literally remove the smoking gun from every case, I would win every case. If I can manipulate the evidence, I will always win. Yeah. If you can manipulate the data in a data-dependent Fed, you're always going to get the inflation rate you think is palatable for the masses. The problem is at some point you can lie about inflation, you can trick the scale, you can repeat the same lie. Americans in general are going to feel it. It won't need a scale. It won't need me and you on a YouTube channel. They won't need a government statistic to know that their dollar buys a lot less every year than it did the year before. And what's sad about the invisible tax of dishonest inflation is it is theft. If we're compounding at 8 to 10% inflation a year, think what you're losing over a 4 or 5 year period if you're saving in dollars.
Yeah, yeah.
I think that's really something people need to think about. And then what is the antidote to that? For us, of course, it's precious metals. For others, it could be the stock market. There are other anti-inflation assets. But I'm saying if you're being robbed at a rate of 8 to 10% a year on your savings, there's no incentive to save. And then you'll take more risk chasing tops in a very dangerous market. Or you can try and find anti-inflation assets that will do you better to keep you from getting poorer, but they won't make you as rich as an IPO and 100 times earning SpaceX example. I'm just saying there's a lot of confusion out there, but keep it simple, stupid. You're being robbed every year just for holding or even measuring your wealth in dollars. And this is something Luke talked about weeks back. If you look at the S&P since Q4 of 2021, the S&P peak at Q4 of 21 to today, the S&P is up 60%, but measured in gold terms, it's down 40. So even when you're measuring your returns in a rising stock market, the purchasing power of the money you measure those returns in is getting stolen from you by debasement and by inflation. So these are not gold bug tricks. They're not little funny statistics. They're proof that your currency is melting like an ice cube under the heat of so much debt. It's just that simple.
Yeah, yeah. I was thinking about John Williams and shadow stats, and like you mentioned, the Fed and like the government and their statistics they put out about inflation. And I asked a simple question, like as a retail investor, I asked a simple question of like, who has what to gain in their numbers. And, someone, John Williams, older, nice man. Like I actually called him to get on the list. He had it where you got to call the number or email or something to get on the list and get the stats. But I gave him a call and he super nice man. And he's getting older in age and such. And like, I just don't think he has anything to benefit by skewing numbers, lying or anything like that. Versus like when I look at like the government and the Fed and the numbers that they need to trick the masses and such about their purchasing power, they have more, I guess, more to lose if they were to, if the emperor were to be seen with no clothes. And so, I just kind of think of that like from a practical standpoint.
That's a very good point. If you tried to get John Warsh on the phone, he probably wouldn't take the call.
Yep.
And if you did ask them a straight question, you're not going to get it. What's the joke? The moment they open their mouth, they start lying. Of course, that's extreme. Not everything is a lie.
Yep.
But we all kind of know that, left or right. I'm agnostic now politically. I'm an equal opportunist cynic. I do, without name dropping, certainly know people in politics.
Yeah.
And I've known some who were in pretty high offices who've always admitted after the fact that they say what they're supposed to say to get the private sector job once they got to DC. That's very simple. They are mostly careerists. They are mostly mavens to the systems. There are some wonderful exceptions. You can pick yours. Everyone has their choice. But we all kind of know this, no matter who we support or have to support. There is a lot more self-interest than public service in DC, much more so than ever. In different regimes, red or blue, we've seen insider trades from every party. We've seen the game. I've seen private sector guys go into DC once they've made their money to run the departments, big pharma guys running, the medical things or military guys coming into Raytheon. They're all just foxes guarding their own henhouse. It's a perpetual revolving door. You can literally fact check that yourself. It's not a big surprise. We know that the K Street lobbyists have more influence on your senators and congressmen than your vote does. So we don't even really have a representative government. These are not even anti-American things to say. These are truths that you can do your own homework on, and you can discover that we're less and less a democracy, and based on our wealth inequality, more and more a feudalistic system masquerading as a representative democracy. I don't think there's anything wrong with our system. I just think it's the people in it and the way it's run today that needs to be changed, not our natural system. It's just run by mavens. And I'm not going to change that. You're not going to change that. I look at gold as one way to at least protect my purchasing power from a central bank that doesn't give a hoot about my purchasing power. Yeah. I can't save every problem with gold. I can't change everything that's wrong in the world in any political system. I just know the monetary system is so inherently broken that I have to be my own central bank. And whether you're making $50,000 a year or $500,000 a year, you can protect your money in some form, whether it's grams or ounces. If you're looking to get rich quick, that's not the play. That's a different conversation. I'm not going to be of much help. I just want people to understand that they're being invisibly taxed in a compounding way, and it's brutally painful to their savings and their ability to get out of a hole that the government has dug for them, left or right. Again, I'm an equal opportunist saying this goes back since time immemorial and since the 70s in particular. But the more people just get these fundamental understandings of the invisible tax of debased currency and misreported inflation, the more they can at least look at anti-inflationary assets, of which gold is an obvious choice. There are others, but that's the choice for me and for my clients from all over the world who are pretty sophisticated.
Yeah. I think about a time when I was working in the courts. I used to be a probation officer, and I was working for the Superior Court judge, and it kind of reminded me of politics, because we would go in and, I have this person's case that I'm dealing with. I have to supervise them and such. And anytime there was any type of violation or anything of that nature, then the lawyer and the prosecutor would come in. They would do their, smiling at each other and, talking and everything, trying to cut a deal. And then we get in front of the judge, and there was some theatrics and stuff. And it was always this kind of theatrical. And one day I was thinking, I was like, we're like, this is somebody's life here, that this is that. And we're doing all these theatrics and stuff, and it reminded me of like the political realm, where if I was thinking about it from a psychological standpoint, maybe, they just get so caught up in the game of politics where, regardless if they're playing with someone's life, it's about getting at the other person or whatever the case may be.
Sure.
Yeah, it's definitely playing with the lives of people, and these are serious issues. And so that's why I appreciate your perspectives and your takes and research. And so, Matthew, where can folks go to read some of your newsletters, things of that nature? I know that you're putting out some good pieces out there.
Yeah, I mean, this interview and other conversations and articles, and going back many, many years from myself and Egon von Greyer's, and Alistair McLeod is an advisor, and Johnny Haycock is writing more stuff, a new partner. All of that can be found on vongreyerts.gold, which is a mouthful. So simplified, you can also go to vg.gold, or V as in Victor, G as in George.gold. That's our website where all our thoughts are posted from many, many years back and up to the last 20 seconds. It's a free education for anyone. You can learn about the narratives in the markets and gold, and certainly with the bond markets and yields and cycles and purchasing power. And there's sections on just not only why you should own gold, but how you should not own it, in particular, not in an ETF paper form, and probably not in a bank vault in a commercial bank for banking risk and operational risk. But it's a free education, and everyone can look at that, and they can question us or challenge us. But the data is fairly, I think, self-explanatory. But it's the more people can get informed for free, that's free. You don't have to be high net worth to get informed. Being informed is far more important than being emotional or just frustrated. And you may get frustrated once you're more informed, once you see it.
Yeah.
But to your point, there's a lot of fugazi with people's lives. It's not sincere. Yeah. There are very few profiles in courage, as John Kennedy would have said, about our current political system, middle, left, or center. I see a lot more opportunism and blatant ignorance. It really is, I joke, like the most mediocre kids you could think of in school now are running the show. And the smarter ones are a little more heroic, a little more subtle, and they're on alternative places trying to share the truth as best they can with the rest of us. But it's kind of crazy to see who's leading the ship right now. But it doesn't matter, again, left or right. It's been pretty bad for a long time.
Yeah, for sure. Well, Matthew, appreciate you and your time. Everyone, be sure to hit the subscribe button if you haven't yet. Love to have your support, and we appreciate you all for watching. And Matthew, until next time, good to see you, man. I'll probably see you again before the conference is up or whatnot. But thank you.
Yeah, me too. All right, Darrell. Take care.